Hello, everybody. My name is Bennett Tchaikovsky, and welcome. Today, we're going to be creating a cash flow projection. This is for managerial accounting. My name is Bennett Tchaikovsky, also known as the accounting professor. My disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District, or California State University at Fullerton. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Sorry about that. So before I say goodbye and thank the bus driver, we're going to come right over here, and we are going to be looking at this question. So I have a lot of things I have to do, including for this coming fall, I'm going to be creating a series of videos that are going to be devoted to financial statement analysis. I'm very much looking forward to that. But I've also been wanting to do a presentation just going through and talking about cash flows. And this is kind of where my mind was, which was these are the different topics that when you kind of think about basically that go into a cash flow for a business, it is very extensive. And this is probably just the beginning. There's got to be a lot more parts to this, but for our purposes here, we're not doing this is more of an academic exercise, meaning that we're going to be going through a company is seeking a 3-month loan. On April 1st, we are a loan analyst and been asked to create a 3-month cash flow to evaluate whether or not LGA should receive the loan. The loan require 1% interest be paid each month, and the full loan amount will be due on June 30th. So the first thing we want to do is, what do we mean by a budgeted cash flow? So if you're taking my accounting 1B or 1B honors course this spring 24 semester or in the future, if we come over here and when you look at basically how does a cash flow really work, right? When we're looking at basically a cash flow, we're not talking about a cash flow in a traditional sense. In a traditional sense, when we have a cash flow, what the cash flow is kind of telling an investor is really about, when we're looking here, we'll just pull up a quarterly report. When we look here at Apple and we go to the statement of cash flows, what the cash flows really tell us are what are the kind of like non-cash items that are included in net income. And when you see it over here, like $3,000 for share-based compensation expense, it's not that big of a number. But if we happen to go over and look at our friends at Meta Platform, right? They're friends, Facebook friends. Right over here, we come over here to financial statements, and we look over here at the statement of cash flows, and we see that, wow, well, net income was 40 billion and share-based compensation was 14 billion. The statement of cash flows on the financial statement serves a very, very important purpose for the investor, because the investor can come through and see the kind of stuff that is included in net income, which may not need to be settled in cash, but can be settled in shares. So the statement of cash flows serves a very important purpose. However, with what we're going through and doing here today, that's not what we're trying to do. As a business, cash is extremely important. You might say that cash is royalty. Cash might be a king or a queen, prince or princess. You don't know. Maybe even the court jester. Who knows? But when we look at how a cash flow is set up for our purposes, we're going to start with a beginning cash balance. We're going to add in the cash inflows. And this is going to be cash from sales or cash coming in. Very important distinction. It's not revenue. It's cash we collect. And then we have all of these different cash payments. So for our purposes here, right, this is basically fine. Rather, what we're going to try to go through and do, though, is we need to create this kind of cash flow for our business. Now, so if you're taking my class and you forget about, oh, how do we set this up? Go to the other cash flow question, look at it, see how the cash flow is set up to give yourself some help. So we're seeking a 3-month loan on April 1st. We are a loan analyst and been asked to create a 3-month cash flow to evaluate whether or not we should give them the loan. The loan will require that 1% interest will need to be paid each month, and the full loan amount will be due on June 30th. So it gives us some information. It says we've got cash of $300,000, accounts receivable, accounts payable. And this is as of March 31st, right? The dates are very important. Then it tells us of the AR balance, 200,000 will be collected in April. The AP balance, 150,000 will be paid in April, while the remaining amount will be paid in May. So let's take a break right there and let's map out what we already have so far. So we have April 2024, May 2024, and June 2024. We're being asked to create a cash flow, right? So the way we're going to do this from a managerial accounting standpoint, and I've worked at many different companies that have used this same format. We're going to start with our beginning cash balance. Well, what is the beginning cash balance? The beginning cash balance is what it was at the end of the prior month. So over here, our beginning cash balance will be 300,000. Now, in this situation, we are going through and we are getting a loan. So we're going to add in here plus cash inflows. And we'll just go ahead and format this now. And we'll have over here bank loan of $1 million. Okay, so we're getting a bank loan of $1 million. Now, when we have this bank loan, 2 things are going to need to happen. The first thing that needs to happen is that we're going to have to go through and pay interest each month. So we have our cash inflows, and this is going to give us we're going to have a loan repayment. So this loan is going to have to be repaid at the end of June. So we're going to have a loan repayment, and then we're going to have interest payments. The loan requires us that 1% interest will need to be paid each month, and the full loan amount will be due on June 30th. So 1% of $1 million is $10,000 will need to be paid each month. This is 1 million times 1%, or 10 grand. So we have to pay 10 grand every single month. Okay, let's continue to go through. So we've put in the beginning cash balance. We've got here April, May, and June. Remember, if you're taking my class, I'm not going to be giving you any of these types of formatting. You're going to have to figure this out on your own. However, again, I do provide you with this, which is a cash flow that you're going to be converting into a financial statement, but that's going to be for a separate question. So coming over here, we have our accounts receivable. Let's read what it says. So the AR as of 3/31, it says 200,000 will be collected in April. So of this 300,000, remember, we're trying to match up over here, how much cash are we receiving? So our cash here is going to be 200,000, and the remaining balance will be collected in May. Okay. Now, the one thing I always want to do is I just want to kind of go through and check my work. When I show this over here, my total AR balance is 300,000. I want to go over here, make sure that works. Okay, now for the accounts payable. Okay, for the accounts payable, It tells me that 150,000 will be paid in April, while the remaining amount will be paid in May. So this is going to be 150 and 50 for a total of 200,000. Okay. So we've got that part down. Let's keep on going. So we've dealt with this very first thing right over here. The next thing we're going to be going through and doing is we're going to go ahead and take a look at budgeted sales. Very important. Budgeted sales or revenues is not the same as cash collected from sales. We need to figure out cash collected from sales. So the way we're going to do this is we're going to go ahead and chart out right up here. Let's go through over here and we're going to chart out our sales. Okay. Okay, so coming right over here, let's pull this information down. So we've got this over here, so we can go through and work with it. So we're going through and estimating the following budgeted sales. Okay, so sales over here. So sales amounts. So this is going to be April, May, and June. This is 800,000 for the month of April. This is May is 700,000. And in June, we have 900,000. Now, what's very important is when we're going through and doing this, right? We're not concerned with revenue. What we are going to be concerned with is, go ahead and format this. What we're going to be concerned with is cash collected from sales. That's what we're trying to get. Remember, when we're doing a cash flow, revenue is great, but that it's an accounting term. I care about the money. I need the cash. So coming over here, when we look at April, of the budgeted sales, 50% is collected in the month of sales. So right over here, this is going to be 800,000 times 0.5, right? And if I want to make this so the budget sales, month of sale is going to be 50%. Month following, the first month after, I'm collecting 30%. And over here, second month after, I'm collecting 15%. And then it tells me that I'm going to be writing off 5%, not collect. Okay, now this has to equal up to 100%, and it does. So as I'm going through and working on this particular question, right? So of the budgeted sales, 50% is collected in the month of sale. So 800,000 times 50%. 30% is collected in the month following sale. 30% or 15% is collected in the second month following sale. Now, if I add up these three amounts, I'm going to get 760,000, right? Now, is this correct? Well, I'm writing off 5%. So the total amount of my sales are going to be 800,000. So the 760 is correct. You have to make sure you go through, follow through on the steps, each one of these individually. Very important to do. Let's go over here to May. How much of the May sales do we make in April? And the answer is not applicable, right? Because unless we have a DeLorean at 88 miles per hour, I think that's what it was, we would not be able to go through and to have anything over here and for May sales collected in the month of April. So over here, this is going to be 700,000 times 50%. We're collecting that amount of money in the month of May. I come over here to June. Well, I'm going to collect in the first month after sale, I'm going to collect 210 or 700,000 times 30%. Coming over here, 700,000 times 0.15, I'm going to get 105,000. Now, if I add this up, it does not equal, right, 700,000. It shouldn't, because we're not collecting 5%. Again, I'm just doing this to check my work. Okay, now let's go to the next month for June. How much do we collect from June sales in April? That's going to be a big not applicable. How about June sales in May? That's also going to be a big non applicable. But over here, we've got 500,000 times 50%. For July, we would have collected 900,000 times 30%. And for August, we would have collected 900,000 times 15%. If I add up these three amounts, I would come over here and I would get 855,000. If I take 9,000, multiplied it by 0.05, or the amount we don't collect, I got this over here. Now, what you're going to notice is for this particular problem, I did not need to compute July or August. I'm only being asked for cash flows up through June, but why did I do it? Well, part of the reason why I went through and did it was because I want to check my work, right? I want to make sure I've done this problem correctly. So as I look at this over here, the total amount of cash I'm collecting in each of these 3 months, again, don't care about July or August, but I did compute them just to make sure my numbers were good. So coming over here for April, my cash collected from sales for the month of April, this is going to be 400,000. For the month of May, this is going to be over here at 590,000. And then for the month of June, this is going to be 780,000. So again, when I look at these numbers here, budgeted sales is not the same as cash collected from sales. By the way, when you are working at a business and you take a credit card, that does not mean that money is going to go in your bank account tomorrow. It can take up to 30 days, right? So when you're going through and looking at cash, it is extremely important you're mapping all the stuff out. So we've dealt with the budgeted sales. Now let's go through and deal with the budgeted cost of sales. So right over here, we've got our budgeted cost of sales. And what we're going to go ahead and do is we're going to do something very similar. Of the budgeted cost of sales, it says that 45% is paid in the month of the cost, while the remaining is paid in the following month. So what we're going to go ahead and do is we're going to go ahead and make a similar chart. And we're just going to go ahead and borrow from this. Okay. So my cost of sales for April were 400,000. My cost of sales for May were 350. My cost of sales in June were 450. Now, this is the cost of sales, or cost of goods sold, is not the same as cash paid for sales, or cash paid for cost of sales, or cash paid for cost of goods sold. So when we look at this, it says of the budgeted cost of sales, 45% is paid in the month of the cost, while the remaining is paid in the following month. So we're going to go ahead and say put 45. If the remaining is being paid in the following month, that must mean we have 55% being paid. I love the math of accounting. It is always the absolute best. And because this must equal up to 100%. So as we come over here for the month of April, how much of this 400,000 am I paying in April? Well, I'm going to pay over here 45%. So I'm paying 45% in the month. And then in the month following, I'm paying 55%. I want to make sure I add these up, and this equals over here to 400,000. Now, how much of May do I pay in April? Well, I've known from the example above, this is going to be NA, non-alcoholic, or in our case, it's not applicable. Dad joke number one. We've got through actually the DeLorean dad joke number two. So coming over here, we've got 45% times 357,000 or 157,500. I'm now going to do 350 times 55%. I'll get 192.5. Want to make sure I add these up. This equals up to 350. For the month of June, not applicable, not applicable. And then we get over here to June. This is going to be 450 times 45%. This is going to be 450 times 55%. Coming over here and adding up our numbers, we end up getting 180 for April, 377.5 for May, and then 395 for June. Again, we're trying to figure out when is the cash going out. Tells us that 45% comes out in the first month, 55 thereafter. So now, as we come up here, we're looking at our outflows. We figured out all of our inflows. Now we're looking at outflows. So cost of sales. So over here, during the month of April, this is going to be 180,000. For the month of May, this is going to be 377.5. And then for the month of June, this is going to be 395,000. Okay, so let's go through and do a recap. First thing we went through and did, we put in the beginning cash balance, right? This is basically the balance as of 3/31/24. Then we dealt with the loan. We showed the loan coming in as an inflow in the first month, and then it's showing as an outflow because it's going to have to be repaid. The full amount's going to be due at the end of June. But what we also have to do with a loan, we've got to pay interest. So we've got the interest right coming in right over here. Then what I did was I looked at the prior accounts receivable, right? What did it tell me? 200 would be collected in April while the remaining would be paid in May. The accounts payable, 150 is paid in April while the remaining amount will be paid in May. I come down over here. What I now need to go through and do, though, is when I see these sales, this is not the same as cash collected from sales. So I converted all these numbers over here. Budgeted cost of sales, right? If it shows up as cost of goods sold, does not necessarily indicate when it's being paid. Okay. Now we come down over here and let's take a look at the rest of the costs. Sales commissions, 10% of sales. Now, generally, when you're dealing with sales commissions, this is going to be 10% of budgeted sales. So this is going to be 800,000 times 0.1. This will be 700,000 times 0.1. This will be 900,000 times 0.1. You generally do not do this on cash collected unless I would say otherwise. Also over here, we have office expense. My office expense was over here at 20,000. And my sales and office staff, this is monthly right over here. This is at 100,000. So I have the following monthly costs beyond the costs listed above. These are monthly, right? I've got to pay sales commissions each month, 800,000 times 10%, 700,000 times 10%, and 900,000 times 10%. My office expense and my sales and office staff costs they'll all be listed over here. Now, when I come down over here to depreciation expense, this is very important for you to know. When I record depreciation expense, how do I do it? Well, if I'm looking at this over here, okay, depreciation expense. I record depreciation expense with a debit. And I'm going to credit accumulated depreciation, right? This is not a draw on cash. This is basically, we're showing the use of the equipment we purchased, debiting depreciation expense, and I'm crediting accumulated depreciation. Note over here, when I take a look at Apple, adjustments to reconcile net income to net cash, I'm adding back depreciation, which is for tangible assets, and amortization, which is used for intangible assets. This has no draw on cash. It's rather how we are using the items. Oh, for Meta Platforms, aka Facebook, depreciation, amortization, 11.1 billion, right? This is a non-cash item. However, I do look at this differently than share-based compensation. Share-based compensation, when you make that entry in general, basically, it would basically debit stock compensation expense, and I credit additional paid-in capital, which is an equity account. Now, why did I go through and what's the difference between these two? Well, this, you ultimately might have to go through and replace it. This is coming out of the treasury. So it's essentially ends up being a gross up. We're actually not really a gross up, but you're increasing additional paid-in capital. And then you're showing this over here as retained earnings. Okay. So when we go now and we look at the next phase of things, is that we've gone over here. So depreciation expense, this is going to be NA, right? This is not applicable, not cash. So if you see this on your exam, which if you're taking my class, you will, you want to make sure that you do not include this in the cash. You don't have to write this as NA. I'm just doing it here so you know not to include it. Now, to finish off our cash, let's take a look at this, how this works once more. So in this particular cash balance right over here, beginning cash balance plus my cash from sales of 125 gives me my total cash inflows or cash available. Then I'm going to go through and I'm going to deduct my outflows, cost of sales, cash paid for interest, insurance, consulting. Total outflows are 115. When I subtract the 115 from the 225, that's going to give me my ending cash balance. The ending cash balance for October becomes the beginning for November. So when we're going through and doing this question, so be really careful about how we go through and do it. My cash available, if I could actually spell, I really should run a spell check through my stuff. That'd be kind of fun. Okay, cash available, beginning, plus the bank loan, plus the AR, plus the cash collected from sales is 1.9 million. My total outflows over here is going to be the loan repayment, which at this point is not applicable, interest payments, prior accounts payable, cost of sales, sales commissions, office expense, sales and office staff, or over here of 540,000. So my ending cash balance right over here, this is going to be 1.9 million minus 540,000. The ending cash balance of April becomes the beginning cash balance for May. So that would be basically my cash available would be my beginning cash balance plus the AR plus the cash received from sales. My total outflows are going to be 627,500. My ending cash balance, therefore, would be over here of 1,422,500. My ending cash balance as of May would then become my beginning cash balance over here as of June. Come over here, my cash available is going to be 2,202,500. My total outflows are the loan repayment, the interest payments, there's no prior AP, cost of sales, sales commissions, office expense, sales, and office staff. So my ending cash balance is going to be 587,500. Okay. Now, let's talk about this. So we've done this correctly. What we're now going to go through and do is, so we've prepared the cash flow for the bank. So based on our estimate, would you recommend your bank to loan the money to LGA? The answer is going to be no. I'm just kidding. Okay, so when we look at should we give the bank, should we give them a loan? Remember, when we're preparing things here in managerial accounting, the way we are going through and doing this is we're really trying to keep the emotion out of a business decision. We're trying to show the numbers. So let's kind of talk about some things we can kind of point to whether or not we should give them the loan. The first one is, should we give the loan? And the first comment I would say is, well, the cash balance increased by 287,500. Now, where did I get that? Ending cash is 587.5 minus 300,000 beginning. So this is a good thing, right? Should we give the loan? The cash balance increased. Over here, let's talk about, well, the budgeted sales are increasing, right? And they basically went from 700,000 in May to 900,000 in June, or an increase of 200,000, or %28%. So my sales are increasing month over month by 28%. So over here, 700,000 or 200,000 divided by 700,000. Now, you also might say, though, this too. I was like, well, wait a second. This is kind of like a little bit of a roller coaster, right? It's going from 800 to 700, then back up to 9. So we would probably want to talk to management, but we could say that this is generally a positive thing. And as we also look at this over here too, what are some other things that we could kind of point to? That's pretty much all I really have. There might be something you can see over here, and if you want to put it in the comments below, that'd be cool. On an exam, I can't really have you go in major depth, right? So for example, I couldn't say that, well, if we had this AR of 100 grand collected during May, it's not enough information for you to take the percentages and back into them. So I think if we just keep it to something like this for this purpose of this test, probably be fine. So, but again, what you're looking for are some really obvious things. Whenever we say, should we give it, or maybe or maybe not, and should we give the loan, it's they say based on, we should give LGA the loan as the overall cash balance is increasing, as well as sales. And I've already documented that above, so I don't need to say it again. And in terms of if we should be giving the loan or not, it's a really, really tough call. But we want to point out some things here. And obviously, if we really are going to give this loan for the amount of money that it is, we would probably want to see historical numbers as well. But it cannot be understated how important this cash flow is. The reason why I say that is that when you go into public accounting, and I've had students who have taken my honors class, I make my honors class create a business plan. And in the business plan, they have to do a 12-month cash flow. And I did do this for some of my 1B classes when I was teaching those in person a while back. But the importance of this is when you go to audit a company, like if we come over here to go through and giving an opinion on the financial statements, we have to go through and make sure, is this company going to have enough money for the next 12, 24 months? because, and the way we do that is we ask the client to prepare a cash flow that we would then go through and review. The problem is that if you're not going to have enough cash, this opinion is not going to be what we call unqualified. The opinion you would be giving will be something called a going concern opinion. What does that mean? We don't know if the business is going to last the next 12 months. And so that's a huge deal. So this cash flow is actually incredibly important for you to be going through and doing. If you are starting a business, it is an absolute must. You have to go through and do this, because if you don't know how much things will be costing you, you'll be out of money before you even know it, because you start throwing in here outflows. I'm going to buy equipment. I'm going to do these other things. It's going to go out of control. But in any event, for my class, one of the questions I will be asking, and I always ask this on my Chapter 20 exams, is I give this type of scenario, and then I'm going to have you prepare a 3-month cash flow projection. So I want to thank you for being with me here today. If you have any questions or an additional comments, please feel free to leave them below. Thanks for liking and subscribing, and I look forward to seeing you on future videos. Have a great night.